There's limited scope for either monetary policy or fiscal policy to do anything if there is a new downturn. Monetary policy is basically out of tools. The U.S. Congress has not dealt with the debt, and there's no political will to borrow money and spend to get the U.S. out of a recession. So there's not much to be done if the economy does start to slow down. Once launched, monetary policy tends to go in the same direction. If you think about this right now, the first movement to raise rates at the Fed will be a historically difficult decision. I was there for the decision to move rates down into the zero range, into the 0 to 0.25%. That was something the Fed had never done, and we were in the middle of a financial crisis, and it was still a difficult step to take. So this first movement for the Fed to change rates is going to be incredibly difficult, and they're going to need to have everybody confident and comfortable before they're willing to move forward. There are tools for draining the reserves. The Fed has a $4.5 trillion balance sheet, and the tools to raise rates are untested. They don't know whether or not they'll work. And finally, the Fed has more confidence in its ability to control inflation that gets out of control on the upside than they do inflation that gets out of control on the downside. They still have not figured out how to make inflation go higher, and so, again, they would be much more willing to let inflation run a little hot for a little bit. The steps to the first increase, things to look for. First of all will be a change in the statement language, the forward guidance that they have. Secondly, there will be a signal in the chair's public remarks, I think probably at a press conference. I don't see Janet Yellen at this point in her chairmanship trying to make this move or signal this move at any time other than an official FOMC event. These press conferences come 4 times a year, and I don't think it would be done at a meeting that didn't have a press conference. The actual first rate move, I am certain, will come at a meeting that has a press conference. So this means it's more likely to be set up potentially with a change in language than the next meeting with a press conference, which is 2 meetings later. Then that would be the chair signals it in the press conference, and then 2 more meetings later, the next press conference, the first rate move actually happens. That would give them a way to really prepare markets and step carefully through this process. So for that reason, I can't see them starting to signal it at their meeting in December. I have a hard time envisioning them starting to signal that rates will go up in March. So I think the earliest they might move rates is September. I would say December is probably more likely. And the difficulty is that any language they choose could start markets moving without them. I think a reference to patience would indicate that they're really focusing on that low inflation. As I said, I can't imagine this Fed, who has finally come out with an inflation target of 2%. They've said that. I can't imagine them risking their credibility by beginning to raise rates when inflation is likely to be significantly below that 2% target. So that's just my take on how long it's going to take them. A couple of factors in the U.S. economy to keep an eye on in the medium term. First of all, the Fed balance sheet, as I said, it's $4.5 trillion, which means they need to drain out $3 trillion in reserves that are in banks. They're going to use the interest rate that they pay on those reserves and some reverse repos in order to try to put a floor under interest rates, but nobody knows whether or not that's going to work. And they're very uncomfortable with making this reverse repurchase agreement program any bigger than $300 billion. And it's hard to drain $3 trillion if you're only going to use $300 billion. Decisions are going to have to be made about what to do with this portfolio. So I would expect them to get short-term rates well established, a path well established, everybody comfortable with what's happening on short-term rates, and then they may have room actually to start to reduce the balance sheet through runoff and sales of their securities. The maturity mismatch, the Fed's balance sheet includes very long-term securities on the asset side with overnight funding on the liability side. Any of you who have ever run a balance sheet like that knows what the interest rate risk position is. Interest rate risk is not important to the Fed. They did this deliberately, but it's going to affect their earnings, and the Fed's earnings are transferred to the U.S. Treasury. And so this could create some real political problems for the Fed, particularly as rates rise. The largest expense item in the Fed's income statement is going to be interest paid to U.S. and foreign banks. And the U.S. public is not going to be happy that the big expense item is interest being paid to the big banks. So I think there's potential for political pressure, and the real danger here is that the Fed could be tied to actions, lose its independence, or lose some of the tools it needs to return to normal. Consumer lending, the regulatory changes that were made have now discouraged subprime lending. There are changes to credit card rules, changes to payday lenders, and changes to ability to pay rules in mortgage and credit cards. All of these mean that consumers who have low income or high debt levels or weak credit scores can no longer fund their spending with credit. And this is going to tend to hold back consumer spending in the US because many of these consumers used to spend with credit. The current debt service is at all-time lows, but there's been an explosion in student debt. Student debt in the US is now larger than all the credit card debt. It's over $1 trillion. And this is the generation, the next generation of spenders who is graduating. Current graduates, about more than 40% of them are graduating with student debt, and those payments are going to be the equivalent of a car payment or a house payment. Housing market recovery may take a while to rebuild the supply chain. There's not enough buildable lots, labor, or materials. And the labor in the U.S., primarily Latin American labor, is a lot of the construction labor. And so I would expect there to be a move to rebuild that labor force. Record low household formation does signal pent-up demand. The scars from the crisis are going to keep credit standards very tight. GSE reform, the two entities that do mortgage lending in the U.S., is going to take years and years and years. There's no political agreement on how to do that. And so house prices and rental rates are likely to continue to rise even faster than general inflation. That's sort of a snapshot of what's going on in the United States, and I'll be happy to take your questions when we get to the panel. Thank you.